So hopefully we have dispensed with the idea of betting as, or gambling as low risk, high return. Any other examples? What might be examples of low risk, high return opportunities? Okay, now everybody's afraid to say, right? So, okay, I'll tell you, my view is there are no low risk, high return opportunities. They don't exist. Everyone has some loophole, like the ones I just closed on all of our gambling. So, why? Why is this the case? Why are there no low risk, high return investments? Okay, I'll explain with a story. How many people have found a $100 bill in the street? Anybody? Nobody, right? How many people have found small coins in the street? Everybody. How come everybody finds small coins and nobody finds $100 bills? Why?
Somebody dropped it already. Pick up by someone.
Yes, because it's exactly correct. $100 bills appear very rarely in the street, and when they do appear, somebody else always finds them first, not you. Yeah, and actually I've asked this question thousands of people, and I have had people that found $100 bills, but you're not going to find one. It's the same way that I will guarantee you that nobody's going to win the lottery, the top prize in the lottery for the entire year. I'll bet each of you $10,000 on that bet. And definitely I'm going to win. Because somebody will win, but it won't be you. Now, why does that happen? Let's take this back to financial markets. What would happen if there was a low risk, high return opportunity? So imagine, okay, let's look at a specific case. I'm a company that needs to borrow money or that needs to get money from investors. How high of a return do I need to pay? What would be the level of return that I need to pay to attract investment? I need to pay a return that's commensurate with the risk. Because investors are going to look at an investment in my company, and they're going to compare to other companies, same risk level, and decide if they want to invest in my company. So what happens if I pay, so wouldn't it be a smart strategy for me to pay higher than the return commensurate with my risk? Because that will attract a lot of investment. And then, in fact, this would be a low risk, high return opportunity. Because my return is, my risk is the same as other companies. My risk is same as other companies, but I'm paying higher return. So should I do that or not? Confusing? Yeah. So let's say investors consider investments on the basis of what? Risk and return. So they look at each investment and say, what is the risk? What is the return? In order for low risk, high return opportunities to exist, there would have to be investments or investees who are willing to pay a return incommensurate with the risk, meaning pay a return higher than they needed to given the risk in the investment. So when might a company do that? Why might a company pay a higher return than they needed to? Because they wanted to attract capital. This would might make them interesting to investors who say, wait a minute, I found a low risk, high return opportunity. I'm going to invest now. But that means the investors will all flood into that investment, and therefore the return will go down. So that opportunity will disappear almost as soon as it appears. Why? This is an illustration of a fundamental law of economics, which is what? Supply and demand. What determines prices? Like, let's say how many people have recently bought some milk in the supermarket? Nobody's drinking milk? Okay, you should drink more milk. So what determines the price of that milk? Is it the supermarket?
The brand, the quality,
No.
expiry date.
No, none of that. It appears like that determines the price, but what really determines the price is supply and demand. What do I mean by that? Let's say that how much does a 1 liter of milk cost? How much?
$2.16.
Okay, let's just say $2. So let's say $2 is average price. And what if one supermarket decides to post the price $2.50? But everybody that's shopping there knows that the price in the market is $2. So what happens to that milk? Nobody buys it. And then what happens to the milk after nobody buys it? It spoils. And then what happens to the milk is supermarket has to throw it out. But before they throw it out, before it spoils, they probably start reducing the price to clear it. Because really supply and demand determines that price. It's not obvious in retail, but it's actually happening. And it's definitely obvious, much more obvious and happening in financial markets. So supply and demand determines price. If the supply of capital for an investment is more than the demand, then the price will go up. If it's less, the price will go down. And the price of capital is what we call return. This is how risk and return relationship is enforced in the real world. So nobody will pay a return. No company or no investment will pay a return incommensurate with its risk for any length of time longer than they need to. Now sometimes, okay, has everybody know what arbitrage is? So arbitrage is a financial strategy where investors look for two identical assets that have a different price. And then they buy one and sell the other one. So this is a way to make very short-term investment returns. So in this case, when there's arbitrage opportunities, you can argue that there was a mismatch between risk and return because the two same assets should have the same risk, yet they're selling at a different price. Therefore, one of those must be a low-risk, high-return opportunity. So these do exist in, for example, public equities markets. And they're exploited by something called high-frequency trading computer programs. Now, you know how long these opportunities persist? Like high-frequency trading programs look for these mismatches that persist for how long? Measured in what duration, what period of time?
Seconds.
So you might think seconds, right? It's not seconds. It's shorter. It's not milliseconds either. It's shorter. It's not microseconds, it's shorter. It's nanoseconds. These opportunities exist for nanoseconds. And that's why only high-frequency trading computers can take advantage of these opportunities. So basically, what happens is, if there are, so I'm going to amend my statement before where I said there are no low-risk, high-return opportunities to say, occasionally there are low-risk, high-return opportunities, but they are erased almost as soon as they appear in the market. And they're erased because of supply and demand, and that's it. So that's why there are no low-risk, high-return opportunities available to you, or to me, or to anybody else that's not in possession